Welcome to Lesson 3. In this lesson, we're going to discuss how credit works. But before we discuss how credit works, I think it's important to back up just a bit and discuss what credit is. While there are various meanings and definitions, including to publicly acknowledge the contribution of another, when you think of credit in the financial sense, you probably think of credit cards first. And those are part of the big credit picture, but they're not the only thing we will explore in this unit. One definition of credit is the ability of a customer to obtain goods or services before payment based on the trust that payment will be made in the future. Sounds pretty straightforward, right? And decades ago it was. A general store in a small town or village might extend credit to locals, allowing them to charge their groceries and pay at the end of each month, or to settle their bill when harvest came and they sold their crops. A lumberyard might extend credit to a home builder in their area so he could buy supplies to build a house and then pay his bill with them once he received payment for his customer at the end of the project. Trust was an important part of the equation because people and businesses had no way to know who was likely to repay them and who wouldn't unless they knew the person they were lending money or extending credit to. Now, the computerization of national and global financial networks means that companies can extend credit based on more than trust. If a customer asks for credit and provides permission for the creditor to look up his or her credit file, they can tell how much the person owes and to whom, how well they've handled past debt, and all of that helps them to determine how likely that person is to repay debt in the future as well. Lenders can extend credit for all types of things. You may take out a loan for a car or house. You may make payments on a furniture or a TV through a furniture or electronics store. You may take out a loan to pay for school or for home repairs, or you may charge clothes you bought at the mall. All of these are forms of credit, even though they don't all involve credit cards. So how do lenders or creditors decide who gets to borrow money or open a credit account when they're dealing with millions of people they have no way to know? In almost every case, they make those decisions by looking at your credit score. When you take out a loan or use credit, you authorize the creditor to report to national credit bureaus on your use of that credit. Did you pay on time? Did you pay in full? And so on. When they compile all of that information on an individual, they assign a credit score, and then they make that score available to any business who subscribes to their service so they can consult it anytime you authorize a credit check. There are several major credit bureaus in the US, and while your score at each may not be identical, they will likely be in a similar range because the credit bureaus tend to consider most of the same factors when they assign you that score. Since they can't know every customer individually, businesses like auto lenders, banks, and insurance agencies also use a credit score to determine if you seem trustworthy. They tend to view credit scores in a range as excellent, good, fair, or poor, and one example of those ranges can be seen in this diagram. But what if you're young and have little or no credit of your own? Because you can't really establish financial responsibility and open your own credit cards and loans until you're at least 18, opening a checking account and a savings account enables young people to show lenders that they can manage money. Once you're able to qualify for your own credit cards or other loans, make your payments in full each month so that you can earn good credit. Later in this lesson, we'll talk more detail about the factors that affect your credit score. One important thing to remember is that credit equals risk, both for the lender and for you, the person receiving the credit. The lender uses your credit score to decide how big a risk you are. You may have always paid bills in full and on time in the past, and so they believe you are likely to do so in the future. But they still charge you an interest rate so that they can make money and so that they can financially account for the risk they take by lending funds or extending credit. Even with a good past history of payments, if you encounter an unexpected hardship and need to decide that you'll prioritize your home and car expenses over repaying a credit card bill, The lender may have to pursue costly and time-consuming legal action to recover the money that you owe them. For a lender, some credit may be less risky than others. A credit card is what is referred to as unsecured debt, meaning that you're quite possibly using it to buy something that is disposable or intangible. Even if you do use it to buy something valuable and lasting, such as a TV, the laws around credit cards do not give lenders the right to come and lay claim to the items themselves, and it would be a very inefficient way for them to collect on what you owe them. Cars and homes, on the other hand, are what is known as secured debt, meaning that if you failed to pay the loan, the lender would have a tangible piece of property that they would be entitled to reclaim and resell. But even then, risk is always present for a lender, and there are costs involved with them recouping their money in any way other than your regular and timely payments. Similarly, you as a borrower are taking on risk. If you buy a car on a 5-year loan, you may have more than enough money right now to make that monthly payment. But if you don't have enough savings and you lose your job, or if you experience a crisis that quickly depletes your savings and starts eating into your monthly expense budget, you may not be able to pay for that car loan anymore. You will incur fees and interest, stress from the collections efforts of the creditor or your own efforts to sell the car quickly and resolve the debt, and your credit score may be negatively impacted by late payments or even repossession. And this won't just impact that car loan. Late payments or debt collections will likely lower your credit score, perhaps even severely, and so any future credit will be harder to get and will cost you more in interest rates and fees. One way that lenders account for their risk in lending money or extending credit is through interest rates. As you saw in the Credit Quest exercise that opened this lesson, two consumers with different credit scores will receive different interest rates on the same loan. While the difference in the interest rate itself may seem relatively small, the effects over time can be quite large. A person with a credit score of 792 may borrow $150,000 to buy a house at 3.483% interest, and they would pay $91,972 in total interest over the 30-year life of that loan. Meanwhile, consumer B, with a 621 credit score, might have a 5.072% interest rate, meaning they would pay $142,265 in interest over the life of that same loan. That small difference in the interest rate would cost the borrower with a lower score over $50,000 more than his counterpart. When you take out some loans, there are two numbers to consider that reflect costs: the interest rate and the annual percentage rate, or APR. This is very common in mortgage loans especially, and although they both describe how much you'll pay, they're not the same thing. The interest rate is the cost of borrowing the principal loan amount. That rate can be variable or fixed, but it's always expressed as a percentage. The APR is a broader measure of the cost of a mortgage because it includes the interest rate plus other costs such as broker's fees, discount points, and some closing costs expressed as a percentage. While we'll explore home buying in another lesson in the future in this course, this is a prime example of how there can be two costs associated with borrowing money. So why are there two numbers? Both the APR and the interest rate are ways for consumers to comparison shop, as well as to determine the affordability of any given loan. The interest rate, however, is determined by prevailing rates in the market and the borrower's credit score. For instance, as we've discussed, the higher your credit score, the lower your interest rate will be. Your monthly payment is based on the interest rate and the principal balance, not the APR. The APR, conversely, is determined by the lender, since it's composed of lender fees and other costs that could vary from one lender to another. You could look at two loans from two different banks with the same interest rate but different APRs because they determine individually what fees they will add into the loan. The Federal Truth in Lending Act requires that borrowers disclose the APR in every consumer loan agreement. We talked in the budgeting lesson about compound interest and how beneficial it can be when you're building a nest egg. But there are two sides to every story, and compound interest can be detrimental when you consider the money you owe. When you save money, especially over the long term, you're not only earning interest on the initial amount you had, which is called the principal, but you're also earning interest on the interest. In this way, it grows or compounds exponentially over time. If you earn 10% interest on $1,000, it's $100 in interest, but the next year you're earning 10% interest on that new total, $1,100, and so on. Lenders like to earn money too. Just as you deposit or invest money to earn interest, they lend money to customers to earn interest, and it too compounds over time. So if you charge $1,000 in merchandise on a credit card at 15% interest, it's important that you pay as much of it off each month as possible. This chart will show you an example of the difference. If you make payments of $50 a month without adding any other charges to that card, it would take you 24 months to pay the bill, and the total of the interest you pay would be $157. But if you paid $100 a month toward that balance, it would only take you 11 months to pay it off, and the total interest paid would be $75 over that time. Doubling your payment would cut your interest and your time to pay off by more than half. Understanding compound interest and using it to your advantage in savings rather than to your detriment in spending can help you grow your money even faster. In the next activity, you'll spend some time investigating credit card options to compare the types of interest rates, fees, and other key considerations in choosing among the many financial options available depending on an individual's credit score.